Hook and promise is chasing high yield today, really worth the potential sacrifice of growth tomorrow. Welcome to the Capital Breakdown, where we take apart finance and investing so you can build smarter, not just faster. In this episode, we're diving into a classic investing showdown: high yield versus dividend growth. Both strategies promise income, but they come from very different places with different risks and rewards. By the end of this video, you'll understand what these strategies really mean, how they work under the hood, and how to think about them in your own financial journey. No hype, no guarantees, just practical insights to help you make sense of income investing. The problem or confusion many folks hear: dividend investing, and immediately think it's an easy path to passive income. But here's the catch: not all dividends are created equal. Some investors chase the highest yields, those juicy payouts that look great on paper, but might ignore what's happening to the company or stock behind them. Others focus on dividend growth, meaning companies that steadily increase payouts over time, betting on future income rising. The confusion often comes because people lump all dividends together, expecting high payouts now without considering what that means for long-term growth or risk. It's kind of like choosing between a big slice of cake today or a smaller slice that keeps getting bigger each month. What's the smarter move? What's the smarter move? Core concept explained. Let's break down these two strategies with a simple analogy. Imagine your investment portfolio as a garden. A high-yield strategy is like planting fast-growing fruit trees that give you a lot of fruit this season, but might not last long or grow much bigger. Dividend growth, on the other hand, is like planting young saplings that start small but grow taller and stronger over time, producing more fruit each year. High yield means you're aiming for immediate income, a bigger slice of the pie up front. Dividend growth means you're planting seeds for increasing income later, relying on the company's ability to grow profits and pay more dividends in the future. Both are about income, but one focuses on today's cash flow, the other on tomorrow's growth. Core concept explained, continued. To put it another way, think about two pipes filling a bucket with water. The high-yield pipe pours a wide stream right now, but might slow down or stop if the company hits trouble. The dividend growth pipe starts with a trickle, but gets wider and stronger over time, filling your bucket more steadily in the long run. Yield is the current dividend payout divided by the stock price, basically how much cash you get for every dollar invested today. Dividend growth is about how that payout changes over years. Both have pros and cons, and the choice often depends on your goals, time horizon, and risk tolerance. How it actually works behind the scenes: companies decide their dividend policies based on profits, cash flow, and strategic priorities. High-yield companies might be in mature industries with steady cash, like utilities or real estate, paying out a large portion of earnings as dividends. Dividend growth companies tend to be more dynamic, often in sectors like technology or consumer goods, reinvesting profits to grow and gradually increasing payouts. Investors access these dividends through brokers, often via funds or individual stocks. Fund providers package dividend stocks into ETFs or mutual funds, charging fees that slightly reduce returns. Regulators ensure transparency and fair markets, but don't guarantee dividends. Money flows from company profits to investors as dividends, and investors may reinvest or spend that income, creating a cycle of cash flow and growth. How it actually works, continued. It's important to remember dividends aren't guaranteed. Companies can cut or suspend payouts in tough times. Also, high-yield stocks sometimes have higher risk. Maybe the company's growth is slowing or debt is rising. Dividend growth stocks might offer less income now, but rely on consistent business growth and strong management. Fees, taxes, and inflation also play roles in how these strategies perform in your portfolio. So, understanding how these pieces fit helps you see the bigger picture beyond just the dividend number on your statement. Simple, concrete examples. Imagine two investors, Sarah and Mike. Sarah invests monthly in a broad index fund that includes many dividend growth stocks. Over time, the dividends she receives increase steadily, helping her reinvest and build wealth. Mike, on the other hand, picks a few high-yield stocks for immediate income. He enjoys bigger payouts early, but faces more volatility and occasional dividend cuts, which can be stressful. Sarah's approach feels like planting a garden that grows bigger each year. Mike's is like picking the low-hanging fruit now, but risking the tree's health. Neither approach is right or wrong universal. It depends on their personal goals, patience, and risk comfort. Simple, concrete examples continued. Sometimes investors mix these strategies within their portfolios to balance income and growth. For example, combining steady dividend growers with some high-yield picks can provide both current income and potential for increasing payouts. But this requires monitoring and understanding the different risks involved. Emotional discipline matters too. Market swings can tempt high-yield investors to sell after a cut or push dividend growth investors to chase risky stocks. The capital breakdown encourages a steady, informed approach rather than chasing shiny yields or quick wins. Risks, traps, and common mistakes. One common trap is chasing yield without vetting the company's fundamentals. A sky-high dividend yield can be a warning sign that the stock price has dropped due to problems, not just generosity. Another risk is concentration. Putting too much into a single high-yield stock or sector can increase vulnerability. Dividend growth investing isn't risk-free either. Growth can stall, and dividends can be cut during downturns. Leverage, options, or margin can amplify both gains and losses, adding complexity and risk inappropriate for many investors. Patience and realistic expectations are key. Dividend growth often requires years to pay off, and high yield can be bumpy. Understanding your time, horizon, and risk appetite helps avoid costly mistakes. Risks, traps, and common mistakes continued. Volatility is a natural part of investing, especially with single stocks. Market emotions can cause dividend stocks to swing in price, even if payouts remain steady. Taxes can also reduce net income, depending on your jurisdiction and account type. Finally, it's important not to rely solely on dividend income without other safety nets like emergency funds or diversified investments. The capital breakdown reminds you that no strategy is foolproof. Risks exist everywhere, and being informed is your best defense. How to think about this tool, income investing, whether high yield or dividend growth, is just one tool in your financial toolbox. Think about where it fits within your broader goals. Are you building a retirement nest egg, supplementing current income, or preserving capital? Budgeting and emergency funds come first, ensuring you're not forced to sell investments in a pinch. For retirement, dividend growth might better match long-term needs, while high yield could support near-term income if chosen carefully. Diversification across asset classes and strategies helps balance risk. Remember, your investing approach should reflect your timeline, risk tolerance, and personal circumstances, not just chasing the biggest dividend number. How to think about this tool continued. It's helpful to periodically review your portfolio and goals, adjusting as life changes. Staying informed about company fundamentals, market conditions, and dividend policies keeps you in the driver's seat. The capital breakdown encourages learning and patience. These strategies reward time and discipline more than quick decisions. Ultimately, income investing is about creating a sustainable financial foundation that supports your lifestyle and future dreams, not just chasing payouts. Recap and educational disclaimer today. We unpack the difference between high yield and dividend growth strategies, two paths to income with different trade-offs. We learned that high yield offers immediate payouts, but can carry greater risk and volatility, while dividend growth focuses on increasing income over time through company growth. Both have a place depending on your goals, risk tolerance, and time horizon. Always remember, dividends aren't guaranteed, and investing carries risks, especially with single stocks or concentrated bets. This video is purely educational and not personalized financial advice. Before making any investment decisions, do your own research and consider consulting a qualified professional. Thanks for breaking down finance with us here at the Capital Breakdown. Until next time, keep learning and investing wisely. Thanks for watching the Capital Breakdown. Remember, this is education, not personal investment advice.